All right, peoples, we got some major news. We're going to look at graphs and charts, of course, but we also have to report on the major news that China has a plan to control the crypto markets, and it's through liquidating Bitcoin and forcing crypto down. But this does connect to another big story that we absolutely, positively have to actually look at. So, China actually just recovered $3.5 billion from a heist in 2020. It is the single largest cryptocurrency hack and went unreported by both parties for years. China mining pool Lu Bien, so I don't know how much the government has its hands on this, but probably some, was hacked in 2020 for 127,000 Bitcoin, valued at about 3.5 billion at the time. It is valued at much more than $3.5 billion right now. 127,000 Bitcoin. I think that's over like, it's about like 13, $14 billion. So think about that being liquidated. Michael Saylor likes that, but he might not have enough money to actually buy it right now. The platform retroactively uncovered the heist on Saturday, claiming that Lu Bien, which emerged as the sixth largest Bitcoin mining pool at the time, was first hacked in December 28, 2020. About 90% of the pool's Bitcoin was stolen by the threat actor before Lu Bien was able to move its remaining 11,000 Bitcoin to recovery wallets. Neither platform nor the hacker publicized the attack at the time, the intelligence platform said. The mining pool embedded an OP return message to each of the wallet addresses belonging to the hacker in 1,516 different messages, which costed about 1.4 Bitcoin. Arkham's team also wrote, it appears that Lu Bien was using an algorithm to generate its private keys that was susceptible to brute force attacks. This may have been the vulnerability exploited by attackers. So obviously that could obviously be the case. The stolen Bitcoin is now worth about $14.5 billion at current prices, and the attack highlights the need for crypto users to practice proactive safety measures and private key management, relying on only the most robust random number generators to create keys. So this is obviously a big thing because they recovered, and this is obviously a Chinese mining pool. So the Chinese government definitely has some hands in this. And that plays into China's crypto liquidation plans to reveal its grand strategy. I don't like it when I hear crypto liquidations. And they have a plan to liquidate to control the price. Because obviously the U.S. is trying to get a strategic crypto reserve, so they can actually control the price through liquidations. They can kind of derail the plan. So China's plan to liquidate confiscated crypto through Hong Kong's exchanges isn't simply a policy. It's to control global digital asset markets and outmaneuver the United States, which is absolutely true. I don't know if they'll be able to do it, but it's their plan. Last week's announcement of Hong Kong's LEAP Digital Assets Policy Statement 2.0 was made with much anticipation and fanfare. The government of Hong Kong promised a comprehensive regulatory framework that will unify licensing and expand the suite of tokenized products. Yet beneath the hype and visible maneuvers lies a far more consequential move. Beijing, the world's second largest holder of crypto, announced its intention to liquidate confiscated virtual currencies through Hong Kong's licensed exchanges, and this is where the $3.5 billion recovery definitely has maybe some consequences for short-term crypto. So it's a strategy of convergence. Hong Kong is poised to become the region's virtual asset hub. Still, it will serve as the linchpin of China's global ambitions, a crypto hedge, a market price vehicle, and a forward command post for PRC crypto liquidity. So essentially, like, a lot of crypto business is going to move through Hong Kong. There's obviously going to be a lot of illicit business within that crypto business. And obviously the Chinese government plans to seize some of this crypto and then sell it on the market. Obviously, this is a big threat to crypto bull runs because if they seize a large amount of crypto in China and they sell it immediately, that obviously drives up supply, which will tank price. So on the surface, Hong Kong's LEAP policy appears to be all the headlines. A proper understanding of strategy, however, demands looking beyond the surface. The true power of these policy decisions lies in the liquidity injection that China's crypto liquidation decision will invariably create. This instrument will simultaneously grant Hong Kong unprecedented influence over global virtual asset markets. The foundation of Hong Kong's regulatory framework can be traced back to 2022 with the passage of the amendment of the Anti-Money Laundering and Counter-Terrorist Financing Ordinance, or AMLO, which after the Securities and Futures Commission had the opportunity to gain sufficient experience under the previous opt-in regime, formally bought virtual asset trading platforms, or VATPs, under their remit via AMLO mandatory licensing regime. This critical move secured alignment with Financial Action Task Force FATF standards and became the first cornerstone legislation for virtual assets. So yeah, they're going to use their seized crypto as a weapon and up their own liquidity and hopefully control Bitcoin price, and it's going to be kind of like their own liquidity pool. So that could actually be dangerous for the United States. Obviously not great for our crypto aspirations, because if they control the price, I mean, they could actually just sell it when it goes up and thereby kill bull runs. So I am not a fan. But that's for the future. Looking at today's graph, you can see that we are crossing a critical TA point. We might actually close below the 50 MA. And that does signal at least short-term bullishness. Right now, the 50 MA is 111,944. Right now, we're at 112,716. Let's actually look a little bit what happened the last time we crossed below the 50 MA. And you can see a little bit of it here, but we were still like, the 50 MA was, like just on June 22nd, we crossed a little below it. And we actually closed a little below it, and we actually went down about 3,000, 5,000 points afterwards. So if that's the case, we could actually go from 112 to 97 pretty easily. Pretty bad for alts, but not too bad for Bitcoin. But as you will see last time, there was an immediate green candle that shot back up and got us above it, and then it went up. After that, we went up to 120. So if it kind of follows this dip here in June, which it definitely could, we would go down to about 97 and then shoot back up to about 130, which would be a good scenario. However, if we look at like essentially the time before that, we're kind of in some trouble, because the time before that, when we were like kind of at level, and then we crossed below, and then we started basically going below, we actually dumped from about 100,000 to all the way to 74,000. So we had a 25% dump in that case. So I think like if we dump below and then we don't have some candles to put us like immediately above, we can definitely be in a lot of trouble, and we could actually go for maybe a 15% dump. I don't think it'll be quite as bad as last time, because this is essentially Trump announcing the tariffs. We don't have an announcement like that. Yes, the labor numbers are bad, but I think that's just going to get Jerome Powell to actually cut faster. So I don't actually think that's going to be that big of a problem. But we do need a candle that completely just boosts us above. Otherwise, we are going to be in for some hurt. On the other hand, the MACD is negative, and it's becoming more negative. So I think short term, in the next couple of days, it does look like we are actually going down, at least for a couple more days. But if you look on the weekly, on the MACD, as we looked at last time, the weekly is still positive. It's getting less. If the weekly actually, this is a one you have to look at. If the weekly MACD drops negative, then we'll have a situation like we did in February where we can go down a lot. So keep your eye on this. If you see this weekly MACD drop negative, then you definitely might want to sell some of your Bitcoin and alts and then come in maybe about a month later. I am still looking at the end of, at mid-October as like the day for an altcoin bull run. And I think like, you know, surprisingly enough, I think we do have like time for another 2-month mini bear market, because that would set us up at the beginning of October for another bull run. Remember, the last mini bear market we had was actually from February, basically like February until April, which is about 2 months. So this time we can, if we have August until October, we won't drop quite as much. Maybe we go down to about 80K, and the next time we can raise up to maybe 150K, hopefully. So we do actually have enough time for another mini bear market right now before we get the big bull market. So 2 months, about that same time period. I hope we don't actually have to do that. But if you want to pick some coins up, like, you know, if you wait a couple of days and then start picking some up, if Bitcoin drops below 100K or not drops below 110, I think it's a good time to start DCAing and picking coins up for sure. because like then altcoins will revert to kind of like what they were in April and May, and that I think you're picking up at a really big price. Yes, Bitcoin can drop some more, and as Bitcoin drops more, you should probably DCA in as Bitcoin drops more. But, like I would definitely start if Bitcoin drops to like, below 110, especially if it gets to that 105 region. I think the liquidity points are around where we are right now, around like the lower 110s. And also there's another one at 92. But if it drops to 92, then we are definitely in trouble. And I think we can like head back down to like 85 or so if we drop to 92. But looking at this graph right now, it is kind of concerning to me that both the MACD is getting more negative, although the weekly is still positive, obviously, and that we are closing below the 50 MA. Now, if we start to get close to the 200 MA, we drop below the 200 MA, then we are really, really in trouble. But I do actually see a lot of like big red candles at this point. And it's not looking as good as it's kind of looking like it was back in February, but I hope it mimics June more than February, because obviously people are going to lose a lot of interest if we drop 25%. A lot of people are going to lose hope, but maybe that's what the big guys are actually looking for. Remember, keep your eyes peeled. Crypto ETFs still come in October. So October, November, December should be a pretty big boon time for us. As long as this China thing doesn't affect us too much, which I don't think it'll affect us to that extent. And Saylor obviously is raising more money. I think he just got 4.2 billion more. I don't know who the hell keeps buying his bonds, but someone keeps on buying his bonds. So he keeps on raising more money. So you got to keep your eyes peeled for that. So yeah, I'm actually like not too frightened of that right now. I do think that there are better times coming, but you might have to ride out another 2 months of mini bear market and maybe pick up some cheap cryptos during that mini bear market right now. And watch out for this China thing. If you see any big Chinese government seizures of crypto, that might be a prompt for you to actually sell temporarily, because they will liquidate that on the market and that will affect crypto. Now, will this cause the next 2 months of bear market? I don't really know. I don't know how much crypto China actually has, and I don't know obviously their exact government policy that Xi Jinping actually wants to do with crypto, but it does not seem like they're that interested in having a Chinese crypto reserve. They are more interested in selling the price and like controlling the price with liquidity sales and using crypto as their own liquidity pool out of Hong Kong. So anything related to crypto that comes out of Hong Kong right now has the CCP's marks all over it. I don't like that, but that's kind of just the way it is. I mean, spot ETFs have seen their second largest outflow, and other ETFs that ended their 20-day streak. So all the signs are kind of pointing to like a mini bear market that lasts 1 or 2 months. I'm hoping it's only like a week or so, but it could be much more. Obviously, the labor numbers are bad, but like I said, that could actually be good for the market, because that will actually prompt Jerome Powell to cut rates easier. But Donald Trump, unfortunately, is replacing the guy with the girl with the bad, or the woman with the bad numbers, with his own person that will give him good numbers, and those good numbers will actually tell Jerome Powell not to cut. So if you want the rates to be cut, you actually need the labor numbers to be bad. So I thought we were kind of going in the right direction. I just hope inflation doesn't pop up to above 3 in the next CPI, because if either in the August or September CPI we go above 3%, or like get to like 3.2, 3.3, I don't think Jerome Powell's going to cut despite the bad labor numbers, because then inflation becomes a real issue. And I do think with gas prices actually stabilizing at this point, and it's not like the gas prices aren't pulling down the inflation anymore, because 2 months ago we actually had global gas prices at around like $56 per barrel, and now it's like around $67 per barrel, kind of where it was when he first took office. And I think that's going to even things out, and it's not going to pull inflation back anymore. And obviously the price hikes from tariffs are going to kind of like take over. Now, we're not going to go back up to like COVID levels of inflation, obviously, but we definitely can get back to around 4 or 5 maybe at this point. And that's kind of what people were expecting of a year ago. So if it does rise closer to 4, then obviously Powell is not going to cut rates. I doubt he is going to raise rates because of all the pressure. And plus, like, he's basically gone next May. So look for a pump kind of like in October, November because of the ETFs. And maybe the 4-year cycle will be trashed and we can look forward to another pump like next May or so when the rates really start coming down. If that happens though, I would get out when it's really high and then just wait for the economy to crash, because that's definitely going to stir up inflation if he cuts it by like 3% overnight. That's going to result in a huge pump and a massive crash. So be sure to sell at the top at that point. So that's the news for today. Let me know what you think. Like and subscribe, hit that bell notifications button. Thank you and have a nice day.